back up, and anybody that is short in this area here obviously is starting to panic, and they start covering, and this causes a reversal, obviously. So absorption came in, the guy stepped into the pit and bought all these orders up, and I'm not saying this is pit trading here, but I'm just as an example, absorbed all the sellers, and the sellers basically were cut off, and buyers recognized this divergence, obviously, and more buyers felt comfortable stepping back into the market, and we traded higher. So that's what we're trying to see as a general concept with cumulative delta. And again, what that would be is aggressive behavior as well as passive behavior, and we can see that through divergences. So let's start to look at some larger perspective time frames here. What we have here is a 500,000 volume bar chart. This is on the ES. Obviously huge volume in this market, which allows for us to use these huge volume bar settings. So what we can see, again, just like we were looking at before, is very significant fractal bottom here in the market. We see the market trades higher and just kind of pauses, and we do see we could not take out that previous high, and we see some liquidation come into the market. Price makes a pretty good lower low, where delta did not quite make as much of a low there. So that it just a clear sense of more buyers stepped in here. Sellers sold down, and again they were cut off, and the market goes the other way. We see a nice fractal there, or a doji, and the market trades higher. And then now we take out that previous high here, and we're trading higher, and then we pause and we make a small pullback. Nothing significant there on delta either. And then we trade higher, we take out that previous high, and we just kind of pause again at these highs. So we can see the market made higher highs, but now we see on delta that it did not make higher highs. So what does that tell us? Well, maybe there is some short covering there, but once it got up to these highs, and maybe stops got cleared out from the shorts, there was no follow through from buyers. So this was really just a kind of a small little stop run type thing, and that was it. And we see that buyers were not participating beyond this small, they probably got out at this swing high here as stops were being hit. That's an area of liquidity, obviously. We know there's inventory sitting up there. So that gets cleared out, and the market immediately comes falling right back, and we see aggressive selling coming in now. So that's what we want to see on a larger time frame. That just gives us a good sense of direction is in terms of potential deeper pullbacks that could be coming into the market there, and that's what we saw, obviously. Let's take another example here. This is actually of crude oil. I believe this is a 40,000 volume chart, so thinner market, less of the setting on the volume bars. Just as a side note, I like to look at the delta, the cumulative delta, paired with the volume bar charts, as opposed to, or tick bar if you want it, as opposed to a time-based chart. And the reason for that is simply these volume bars eliminate a lot of the noise that time-based charts would when looking at this. So this is my preference there. But in any event, we see the same type of behavior here. We've got a somewhat of a balance area, and then finally the market sells off from that balance. We see that reflective in the delta, and we see that the market really just came and tested the lower end of that level there. And what that tells me is anybody long there, once the market came back to these prices here, they most likely covered their long positions if they didn't get stopped out. So they got out, obviously for a loss there if they're long from here. But anyway, we can see that reflective in the delta there. And then we see more selling come in, and then we see a very strong vertical move down here, just very strong move. And what we're seeing on the price though is that it's not as strong. So again, as I just walked through on that smaller references, we see sellers are really hitting the bid going down here, but they're not being very successful in getting the market lower. So what does that tell us? It tells us that there's buyers absorbing these lower prices. And then finally we see kind of a flush lower. So this is maybe some weak hands or had stops sitting down here, and market flushes lower, takes out those stops, and then immediately comes right back into that range. What does that look like on our delta then? So again, we see a strong move down, not very successful. So maybe some covering is starting to come in, and then finally we get that flush move lower. However, delta does not make a lower low. So I guess that's a little opposite of what I just showed in the previous chart. But again, it's a divergence that we want to take note of. Price made a lower low, but delta did not. That just meant that buyers absorbed these lower prices as well. So kind of a little opposite of what we just looked at, but it means the same thing. And again, it's a good heads up that there's potentially a strong reversal about to occur. Sure enough, since that point, this market has traded much higher. We can also, what we can do here is, we're looking at the same chart, zoomed out a little bit, but same thing. And what I have here is that going back to the whole VWAP concept, is I've got an anchored VWAP from this key breakdown fractal point. So here we have these lows here. From this high, the market broke below that support. So I've anchored a VWAP from this high, and we can see that the market was reactive to the ongoing VWAP here as the market continued to trade along here, and ultimately it broke down and became incredibly imbalanced to the sell side. What we have below here is a volatility-based moving average. And the reason why I have this on here is it appears to be very reactive to the market when it excuse me, reaches this level here. So think of it in the same terms as any other volatility-based reference or even a VWAP, is that we typically will see some sort of a reaction there, and finally it broke through there. We saw the market trade back into value here, and then it tested the top of that, and really that was confluent with the value low, so it was somewhat of a brief balance, but for whatever reason the market fell back out of balance here. We saw more selling from VWAP, and now we were trading below our volatility based moving average, and then on the pullback here was confluent with our VWAP. So again, just kind of confirmation here, but we see again that strong liquidation as the market goes lower, and just kind of going crazy. Of course it did get above our moving average here a bit, but it ultimately fell right back below. We're still trading outside of value, and again here we see that being reacted. We see a double top type thing here with major divergence there, and selling really pushed lower here. However, price really didn't get that much lower, and then we see our flush here, and then we see this strong break above our moving average right here, which was really a heads up before the market came back into value. We also see our volume profile plotted to the right here, gives us a sense of our balance areas and where we can typically expect the market to rotate between. So we had a distribution here, and then a fast move, and then we have a distribution here. So it all comes together in that way, and this is why I like to look at it in this sense, is just giving us kind of a marriage of all this information into one chart like this. So a very powerful reference in that. So I think it's a very helpful analysis tool looking at the bigger picture. So that's it for the market profile, volume profile, and cumulative delta. And the idea then, as I had said before, as I walked through, is looking at the path of least resistance, looking at the bigger picture market structure, but also measuring the aggressiveness and successful outcome of either the buyers or sellers through the use of the cumulative delta. So it all comes together as a very nice, powerful piece of information. Okay, now let's take a look at how I draw up my support and resistance levels. Again, this is just larger time frame, more or less just reference, or it's a suggestion of there being support or resistance at a particular area. These are not being drawn out for specific trade locations. It's again just a suggestive idea that the market may be supported or find resistance at a particular level. So let's take a look at that. So what we're doing here is looking at support and resistance levels in the traditional sense. Not everybody's looking at market profile, VWAP, or EMAs for that to determine key levels of support and resistance. So what we're doing here is using traditional candlestick patterns that can provide us with clear levels of supply and demand. Each candle provides us with information similar to looking at a market profile graphic. So what I mean by that is the body of the candle, as I said before, is the acceptance area, while the wicks are the rejection areas. Support and resistance levels can be clearly seen through candle body and wick formation. My personal preference is that I use the daily RTH session bars, and of course, as I said, these levels are not precise trade locations. They're simply suggested potential support or resistance. The market may trade above or below the resistance levels before looking for rejection or providing or creating a wick. So let's take a look at what I have here. I'll just start on the bottom here when we see that we have a level that was for 2 days somewhat of a resistance area, and then the next day the market opened above this potential well, now since we were above it, we would think it would be support. But we can see that the market actually traded well through this level, but it ended up closing right on top of that. So that's what I mean by these being not precise support or resistance, but they are suggested areas that maybe going forward will be important for us to keep an eye on. So we can also see that the market, once it found that support, we can see the next day the market had a strong move higher, and then the following day we gapped up. So again, we could say that there was potentially some resistance being set up there, and then the next day, of course, we gapped above it and tested the top of that resistance for 2 days, and then just continued to auction higher here. And then what we see here is when the market finally came back to that level, it was supported there. So we know there was a gap there, of course, but it was supported there, and then we saw a good, strong reaction or bounce up out of there. And then finally we came down and tested again, and what did the candle do? It closed right on top of it. And then the next day, of course, it traded up out of there. The following day, closed right on top of it. The next day, it really just opened there and ran right to our next support area. So it just kind of helps us identify, as I said, potential support and resistance areas. If I were short going into this level here, I'd probably be looking for potential signs of exiting the trade if needed. And of course the next day we see we opened just above it, we traded through it again, and we closed on top of it. So we can see that this was still a valid level. But then the next day, even more interesting, is that we opened right on top of our previous support area and just a strong move up out of there. And then we just kind of one time framed higher, and we finally just kind of paused here and created somewhat of an area. So what we're seeing here or what we're looking for is the wicks of these candles and then the base of the body of the candles. So we can see that there is something setting up here. We finally are supported there. We trade higher, establish some resistance, come down, test the top, test the resistance, strong bar right down to our support level. The next bar opens right on it, just rips higher, right back to resistance. We get some pause, and then finally the market breaks right through that level. So the expectation then is that potentially the market would come and test this level one time. But when you see a market just trade right through a level like that, it could just simply mean that something has changed there, and that level is no longer a very important level to really watch. So again, these are just visual references or helpful ideas to see where maybe the market will be supported or find resistance at in our analysis, and just get a sense of, as I said, areas that we may see some sort of a reaction occur there. So there may be other reasons, confluent levels, or maybe Fibonacci or whatever else that's out there, but these levels are very clear, again, with the wicks, or what we're looking for, and the base of the bodies of these candles. So very simple stuff. We can look at it on a larger time frame as well. So here's the weekly bar chart, same concept. Here's a level of resistance. We finally break through it. We trade higher, find some more resistance, trade down, and this bar just kind of trades to it and closes above it. This one opens above it, trades through it, and then reverses through there. So Again, just a suggestive area of potential support. We come back to our resistance area here, just blow right through it. We also had we opened right on a previous resistance as well, and just strong move up out of there. We make a pullback and we find support there again. So we can see that it's useful even on a larger time frame. But I personally, I just prefer to use the daily bars simply because we're seeing more detail there, and the levels themselves are a lot smaller, so they can be a little more helpful in your intraday trading. But that's pretty much it as far as drawing these out. Is I'm not using fractals as potential support or resistance. It's really just these the wicks that are showing us these levels. And here's a great example right here where the market was continually closing above this level. So that's really what I'm referring to here. So again, we're not using fractal points, we're not using some sort of a mathematical equation or anything else. It's really just kind of old school candlesticking stuff that we're seeing here, is just these support and resistance levels that are very clear in the market. And that's it. Also, one of the nice features with Sierra Chart is that I can actually plot these lines onto my other charts as well. So I can overlay them onto my other charts, so I know that I can watch the price action and look for confluence and things like that when we get to these areas. So for example, maybe an open here, we test that support area, maybe there was something else there as well. So obviously that would be a nice trade location based on that confluence. And that's kind of how I use these. It's just, again, nothing, there's not a science here, it's just real straightforward stuff. I'm not using wicks. I'm basing this off of the areas of excess, just like you would with market profile, areas of excess. So anyway, that's pretty much how I use it. There's really nothing else to it. Okay, so let's move forward here. Let's talk about Fibonacci levels. Again, you might be wondering, well, how are Fibonacci's fitting in with the whole auction market theory process, and looking at the markets from a larger perspective and into the smaller perspective? And I think the answer to that is actually pretty simple. It's the way I use these is I look for the market to go from one extreme to the other. Standard bell curve type of thought process. I realize that the numbers themselves are somewhat of a mathematical sequence, but I guess the visual that or the expectation of where the market rotates to is from that one extreme to the other type of thinking, rather than a very specific type of straight line. And it makes sense in that way. So let's kind of walk through this here. So Fibonacci levels, as I said, are an excellent tool in seeing the big picture support and resistance levels, but it also provides us with a bigger picture price target expectation, which I'll show you. And as I said, I look at these in the same sense as other auction market theory concepts, in that the market will test one extreme and then rotate to the other extreme in that whole bell curve like thought process. Fibonacci levels provide us with a series of measured moves, which are very helpful in identifying the potential changes in a bigger picture trend, or of course the continuation of them. And the following numbers is what I use for my Fibonacci levels. Of course, the anchor point is simply our 0 point, or middle point, I guess you could say. Then I look at the 23.6, 38.2, 50%, which is really just half back. I know it's not really a Fibonacci number, but it's still useful to see the half back moves. I then look at the 61.8 level, the 78.6, the 100%, so that's my second anchor point, and then obviously the other extremes, so the negative 23.6, the negative 38.2, the negative 50, the negative 61.8, the negative 78.6, and the negative 100. So in that way, we're looking at the standard deviations, if that makes sense. So measured move reaction zones are typically the 50% to the 61.8% levels, with the expectation of the market rotating to that other extreme. Levels are always drawn out from left to right, low to high for upward trends and high to low for downward trends. And I'll show this in a minute. When a market does not make a full pullback or full half back move and just takes off, we need to draw out an extension. This is usually from the previous measured moves, anchor high for upward moves and anchored low for downward moves. And lastly, just again, we're looking at larger perspective stuff, so I like to use the RTH daily bars for this. I think it provides us with the cleanest levels, and again, when we're drawing from all these fractal points and everything, it can become very subjective, and I think it's really important to not fall into that and draw Fibonacci levels that really mean nothing by using these smaller time frame charts. I think you really need to use larger time frame references in the context of looking at a top-down analysis approach. So here's an example of some measured moves that are taking place here. I've kind of shaded this this low, I've shaded the high, and here's our pullback here, and then there's our target. Here's another pullback, target, pullback, target, pullback, target. So we can see that there's measured moves occurring here, and I'll show you how these work out. So here's our significant, our key fractal low point. So we pull from the low to the high, so left to right. Here's our high, here's our low. We have a halfway back actually to the 61.8 level there, and we see a clear reaction to that as the market takes off and runs to the other extreme. So you can say that if you were to just draw out a bell curve, you can see how it went from one side of that curve to the other. Very simple. So now let's say here's our key pullback here, so that becomes our next area that we want to anchor from for our next measured move. So we pull from the low to the high. As we saw, the market actually ran a lot further than our expected target area, so that certainly is a heads up. But we do pull from the low to the high, and we see that the market does not make a halfway back or a pullback to the 61.8 level. It just really pauses all the way at the 23.6 level. So when we see that, that really just tells us that we need to draw an extension move. So what we did is, here was our previous low to high, here was our pullback, and that was our target. What we want to do, as I explained earlier, is pull from the previous high, or the anchor point high, to the next high. And when we do that, we see that we did have excuse me, a measured move pullback here. And from that point, we went right to the other side. So target is obtained, and we continue on and do the same process over and over and over until something breaks. And then when something breaks, we just need to adjust our anchor point to the one pullback before that, and we see that it works. And if obviously that breaks, then obviously that's a clear heads up that that trend has changed. So the idea there is just to use these key fractal points and have clear expectations where price will tend to migrate to next. So same thing, the whole bell curve concept. So let's talk about what we just went through, all this information. I mean, that's a lot of information to cover, and on a daily basis, of course. And I mean, those are a lot of charts, those are a lot of different filters and pieces of information that we're looking at. And I think you run the risk of, as they say, analysis paralysis. And certainly that is not the intention here. What we're trying to do is look at these important key references and bring that into one simple concept and idea of what the market is telling us, and more importantly, to not let it confuse us in any way. So let's talk about that. So to simplify everything, what I use is I've created a spreadsheet that just provides me with a quick glance at the various time frame filters, and it just immediately tells me what's going on a larger time frame when I'm looking at the markets on an intraday basis. It's kind of like it keeps yourself in check, if you will, as to what to expect, what's the market going to do, and you always stay on that path of least resistance. Again, this is a lot of information, so Am I updating this on a daily basis? Absolutely not. That's just too much work, you know. So what I like to do is just update that on a weekly basis, say like on a Saturday or Sunday, just, you know, update any information that may have come to light, or you know, just go through the filter process and have that all ready to go. In fact, within Sierra Charts, I do have a special template that just I can quickly click on it, and it has all my larger time frame reference charts there ready to go. So I don't have to have a whole bunch of charts open on my, you know, intraday trading charts, I guess you could say. So it's just kind of preserves space and everything. And of course, by doing this, we're just determining whether the market is balanced or imbalanced, and we're just identifying that path of least resistance. But it also helps to keep track of other key references such as support and resistance levels, as I just shown, as well as Fibonacci levels, which gives us our, you know, target expectations, but also helps us with our bracket extremes. As I had mentioned, when we're in a balanced environment, we simply don't want to be selling into support or buying into resistance. So a lot of information, and then what we do is just bring that all in together, as I said, into a simple spreadsheet, and it would look like this. So what we have here is and this is available in the download with this video, obviously. But we have is, it's got my this is what I refer to as my market analysis report. And for this particular market, this is the S&P contract. This is obviously dated information, but this was back on October 2nd, 2013. We just look into our table. What we have here is that we have structure, bracket high, bracket low, position within channel, EMA structure, VWAP structure, previous VWAP, market profile structure, and POLR, which is the path of least resistance. So if we look at this, we can see just on the pure bar charts alone, the market structure is imbalanced, meaning that's one time framing, but not only that, it's you know, ripping out to higher highs. Same to be seen on the quarterly basis or quarterly bars. And then when we look at the monthly, we had some overlap occurring, as well as the weekly and daily. So we can see that just by looking at this information alone, on the shorter term, there's the potential for rotational moves. Of course, it all depends on where we're trading at, but that is a key important thing. There's the shorter term is rotational, while the longer term obviously is still very strong to the upside. So really that just helps with our identifying the path of least resistance. We can see that we had a bracket high and low, and you know, if the market's not trading within a current bracket, what I typically do is put the previous bracket levels in there until we establish a new one, because that's helpful in saying, well, if we have a pullback to say 1630, I will look for a rejection there. And the same rings true with all the other smaller time frame references. And then the next piece is you know, position within the channel. I mean, if you looked at the yearly on the back adjusted contract, you know, it's clearly a strong breakout to the upside. You know, the quarterly, we were at the first standard deviation level, the monthly second standard deviation level, weekly first standard deviation, and then on the daily we're actually trading at the mean. So obviously that's a smaller reference there. So on the EMA structure, and I believe during this time there may have been somewhat of a pullback in the market, but you know, on the yearly, I'm not looking at EMAs on the yearly, that's just too big. In this one I actually did look at quarterly, but typically I do not look at the quarterly or the monthly at that really. But you know, just for the sake of this reference here, we had short-term trends, meaning that the market was trading at either the 5, 10, or 20 EMA. And then on the daily, we have a neutral, and that was most likely trading between the say the shorter term and the longer term moving averages. So just kind of a rotational type of environment there. And then when we look at the VWAP structure, as I walked through earlier, you know, it's saying the yearly was balanced. So what does that mean? That most likely means that at that particular time the market was trading inside of the current VWAP's developing value. However, we look at the next column here, we see that the market relative to the previous VWAP value, I'm speaking in terms of value here, was imbalanced, meaning that we were trading well above our previous VWAP's value area. Quarterly was again trading within value as well as the previous. Same all the way down. However, if we look at on the weekly relative to the previous week's value area, we were trading above it. And then the daily, it's just too micro there, so I wouldn't put much or significance on that, but we were trading above it most likely there. Or I'm sorry, below that. Same with the weekly, because I'm seeing something here. Market profile structure, obviously imbalanced. As we walked through earlier, those yearly profiles, very strong breakout to the upside. Quarterly at that particular time was balanced, as well as the monthly, and then the weekly was actually that pullback that I outlined earlier there, showed that we were imbalanced to the downside. Of course, the daily we had a pullback going, so it was lower. So just zooming out again, what is our path of least resistance based on all this information? Well, we can see on the longer term we had, obviously it was to the upside. Same with the quarterly, to the upside. If we look at our monthly, we actually are at a neutral point, meaning that there's no significant side of the tape over dominating the other. And then as we got to the lower time frame, we can see on the weekly and on the daily, the path of least resistance was actually to the downside. So if we were to look at this in a bigger picture and say, well, until these larger time frame references all turn down, then these small, I guess you could say, imbalances to the downside were most likely going to be limited. So it helps us with our intraday trading, but it keeps us in check with what the bigger picture is telling us. So we don't want to become, in this example, overly bearish. And you could almost theoretically say that this is, instead of it being the path of least resistance being down, it was almost neutral. But we are looking on smaller time frame references here, so if we're intraday trading, we really want to stick to that type of information there. And then, as I shown how we draw out our support resistance levels, at that particular time we had near support levels of 1670 and 3/4 and 1663.50s. And again, that's just based on the bar charts that I had displayed there, the price bar chart or candlesticks, and the wicks, the bodies and the wicks. We're providing us with these two clear levels for support. And then, of course, resistance, we had these two levels, 1695s and 1723.50s. So those are two price levels I was keeping a close eye on, obviously. And then going into the Fibonacci levels, all I do here is just fill in the current measured moves levels. So if we pulled back to 78 1/4, my expectation is that we run to this 68 3/4 area, or the 91 1/4, which is 61.8 and 50. And then at the time there was a small potential bearish measured move in place, but obviously that got blown through. But those are the levels I had there. So in summary, really all I'm doing here is all this information. It really just helps to educate us as to what this market's doing, and helping us stay on that path of least resistance, not become overly biased. And as I said earlier, in this context, we don't want to be overly bearish, because the bigger picture is still telling us something differently. So it keeps us in check. It keeps us in the know of what's going on, our important levels. And that's really the most important thing with what we're doing when we look at the market from this macro perspective down to the more micro perspective, is staying on the right side of the tape. This is probably the most important thing here. And obviously when we go into the trade methodology piece, we build that information, or this information, into what we're doing on an intraday basis. But I just could not stress enough how important it is to look at the market from a large perspective and bring that into a smaller perspective, because this right here tells you everything. This path of least resistance, when the market's starting to sell off, people think that the market's going to crash, but we don't see any of that confirmation on the larger time frame, so we don't want to be overly bearish. So that's just really, it just keeps us in check. So anyway, that's pretty much what I have here. And as always, if you have any questions, there is a place on my the Private Banker forum that I have all this information, and of course you can feel free to ask your questions within that area. I'll also be posting an area on my blog. If you have questions for me there, that would be also an area for you to answer or pose those questions. But I hope this information was helpful for you. And of course, as I said earlier, this is a lot of information, and I'm certainly not expecting you to use all these different filters or tools. But the idea here is to show you what I'm using, and for you to maybe identify a few of these things to help you with your larger picture analysis on the markets. So with that being said, thank you for watching my video, and look forward to providing more in the future. Thank you.